This podcast is intended for investment professionals only. All investing involves risk. Hello and welcome to Market Talk, our regular audio digest of what's going on in markets today and how investors can separate the signal from the noise. In today's episode, we'll explore where we are now in the interest rate cycle, what happens when economic data and US party politics collide, and whether the AI spending splurge is bearing fruit. My name's Harry Brooks. I'm a content manager in L&G's asset management business, and answering all these questions and more today is Bennett, Head of Investment Strategy, Asia, who joins us today from Hong Kong. How are things, Ben? Are you pleased to be back home after your recent travels?
Yeah, pretty pleased to be back home, except we've just had some rather crazy weather here in Hong Kong. It's been black rain, which I guess people have seen it on their social media feeds. It's been torrential rain. I think more than 100 millilitres, 4 inches in an hour type rain. So yeah, just about survived that. Today's a bit drier, thank goodness, but that's been the last few days.
It's quite an ominous name, isn't it? Black rain. Obviously isn't going to be something good. Okay, well, getting on to onto our usual topics conversation. Last week, we got the US Federal Reserve's interest rate decision, and despite calls from President Trump for an immediate rate cut, the committee opted to keep rates on hold for now. What were the main data points that would have informed that decision, and how did markets interpret the messaging from the central bank that followed the decision itself?
I think the overall message is uncertainty, which I think is fair enough, isn't it? I think we're all dealing with a lot of uncertainty. I mean, economic growth is okay in the US. We actually had Q2 GDP come in at 3% annualized. So that's totally fine. And we've got unemployment, in terms of the unemployment rate, at least, near cycle lows. And yet you've got this uncertainty around the impact of the spending bill, which has been passed, but we don't know how that impacts growth going forward. Tariffs, we don't really know what all tariffs are going to be, let alone what the impact is on growth and in terms of inflation. And then those immigration controls, which is curtailing labour supply. So all that added together, I think the Federal Reserve has decided, let's give it another couple of months at least, and let's see what it looks like in September for that meeting. Maybe we'll cut in September, but I mean, they weren't even saying that particularly. It was real uncertainty. And straight after that meeting, which was in the middle of last week, the market's pricing of a rate move in September, of a rate cut in September, was basically 50-50 whether or not they would or not do it. So again, that message was heard clear and loud. It's uncertain. So that was a 50-50 chance for the next meeting to be cut.
Okay, we're sticking with the uncertainty theme. Something else we saw last week, of course, was the release of that jobs report, which suggested that the US economy had added fewer jobs over the past 3 months than had previously been thought by quite a bit. Just hours after that report was released, of course, President Trump sacked the head of the country's labour statistics agency. I'm interested in what an intervention like this could mean longer term. I wonder if there are parallels elsewhere in the world where we've seen politics and economic data collide in this way before.
Yeah, we definitely have. But just to talk about the labour conditions to start off with, and I mentioned uncertainty before. And look, this is still... this shows you the level of uncertainty, really. The surprise were the revisions to past data. I mean, the number of jobs created in July was announced to be about 70,000, but the last couple of months were quite strong. However, they were revised down by a cumulative 258,000 for May and June. That was a downward revision. And that, to be honest, it's fair enough to some degree because, you know, post-COVID, even post the financial crisis, the submissions, at least at the beginning for these labour market surveys, and that's what they are, surveys, have really dropped off. So the initial number for the last month is always a bit of a guess. I mean, it's an educated guess, but the revisions are fair enough. These were particularly large revisions, though, which clearly puts President Trump in a bad mood, and he decided to fire the person in charge of the data, suggesting that there could be some political impact in that. And look, and that's he's questioning the credibility of the data, and as investors, you know, you have to take that into account and fine, the data itself is difficult to get right on day one. And again, that's not going to make the Federal Reserve's job any easier, is it, in terms of their understanding of what's going on. Now, the person in charge of the Bureau of Labour Statistics is not just in charge of these payroll numbers. Actually, despite what's the name, the labour statistics, also in charge of CPI data, which is hugely important too. So again, putting that uncertainty in everything is not particularly useful at the minute in terms of trying to trade markets.
Interesting. Okay. Well, earlier this week, another interesting thing you shared was a chart that showed the difference between the yield on 30-year US government bonds and the 2-year equivalent. And it showed a clear trend of the gap between the two increasing, curve steepening. In simple terms, what does this evolution of the yield curve tell us about what markets expect to happen next?
I think we're hitting a theme, aren't we, Harry? This uncertainty concept, and in effect, that's what that curve steepening is telling you. So, short-dated government bond yields is in effect telling you the immediate trajectory of the Federal Reserve, what their interest rates are going to be over the next whatever it is, 1-2 years, depending on what bond we're talking about. I look at the 2-year bond just as a benchmark there. So what's the average of sort of interest rates going to be over the next 2 years? And that's fairly well defined. I mean, there's a lot of uncertainty, but it's fairly well defined. The long dated interest rates, so we're talking 10-year, 30-year bond yields, well, that's got something to do with long-term interest rates. So where will long-term growth be? Where will inflation be? And there's some sort of risk premium, term premium associated with the uncertainty around inflation, long-term growth. And look, if investors are worried about or lacking confidence in potentially inflation targeting, if there's going to be political interference with the Federal Reserve, which has done a really good job at keeping inflation low, well, maybe there should be some risk premium for what inflation might be in the future. So maybe that term premium, that 30-year, 10-year yield should be going higher. And that should, in effect, then turn into a steeper curve, couldn't it? And we have seen that so far this year. The 2-year bond yield so far this year is roughly 0.5 percentage points lower than it was at the beginning of the year. And that's factoring in, future rate cuts by the Federal Reserve. The 30-year is flat. It's unchanged compared to what it was at the beginning of the year. So despite investors factoring in lower interest rates in the short term, they've kept long-dated interest rates relatively elevated, and that's pretty important for the cost of interest, long term for the US economy.
How do our credit desks feel about this curve steepening trend? Do we agree with the consensus, or are we looking to take the other side of the trade here?
Yeah, a bit of both, actually, I think is fair to say. Look, it's valid. I think that the curve should be steeper based on the uncertainty that's going around. But actually, the governments can choose, or at least Ministry of Finance, the issuing entities of these governments that actually try to raise money in the bond market, they can choose to issue shorter dated bonds rather than long dated bonds if they believe that the long dated interest rates are too high. So they could just shift where they supply the interest rate. And if there's no long dated bonds being issued, then there will be this sort of supply demand issue. And that's another part of where bonds are trading, of course, isn't it? It's that balance between supply and demand. So if they stop issuing long dated bonds, then you could see those bond yields at the long end start to fall, and short end maybe go up a little because there's more supply. So that would flatten the curve. So we've got to be thinking about that from an investment point of view. And we do look at that for certain countries. We decide that we want to maybe push against some of the curve steepening. But back to the US, like I said, I think it is valid to some degree. And in some of our unconstrained bond funds that don't have to hold long dated US Treasuries, we've generally pulled back from that long end of the curve because we worry about that uncertainty.
I wonder as well if the same underlying factors, expectations of rate cuts in the nearer term, coupled with longer term fiscal strains and uncertainty about inflation, is that leading to this same dynamic of curve steepening in other markets?
Yeah, it's definitely a common theme. So whereas we're a bit worried about the US long-term part of the curve, the curves are also very steep across many other markets. And what I was mentioning earlier in terms of the ability for those governments to choose where to issue the bonds, that's, we've decided to put some curve flatteners on other parts of the market. So the UK, for example, and Japan, we have curve flattening trades on, with the belief, I mean, that both those countries are suffering from big deficits, a bit like the US. Both those countries are suffering from inflation uncertainty caused by themselves or other governments, let's say. But they also have the ability to issue shorter dated, and they have to some degree. I mean, both Japan and UK issuing authorities have shifted where they have issued bonds in order to try and keep interest rates a little bit lower at the long end. So those are trades that we have got on in some portfolios. So yeah, there's a lot of volatility going around, a lot of different curve shapes, and we'll try and look at relative value between different countries and try and think about what are the incentives for the issuing countries and where would they want to have the curves.
Always comes back to incentives, doesn't it?
Yeah.
I'm conscious so far that I've focused on Western markets. What's been the focus of investor thinking in Asia over the past week or so?
Yeah, there's plenty of stuff going on here. It's meant to be, isn't it, the summer doldrums or whatever. It's going to be quiet, isn't it, the summer? But actually, there's been huge things, particularly in the US, but also in Asia. So maybe the three things that I would highlight. South Korea, there's an amazing performance by the equity market so far this year. The Kospi up sort of over 30% in South Korea. But the government has decided that this might be an opportune moment to change tax laws and maybe tax people for some of their gains in the stock market. So we had a bit of a correction on those headlines, and we don't know for sure if the tax will be changed, but there's been some volatility around the Kospi, the South Korean equity market, over the last few days. Japan, I mentioned Japan before about those curves being very steep, maybe factoring in some fiscal spending. Remember, they had the election a couple of weeks ago that was triggering talk about maybe more handouts. Yeah, and that seems to be coming to the fore. It's been a boost to equity markets, easier funding, sort of fiscal spending generally boosts equity markets, weakening of the yen, and also those higher yields that I was talking about before. And then finally in China, we had the monthly Politburo meeting. The July Politburo meeting is quite important because it looks ahead into the second half of the year, and so investors were hoping potentially for some signs of more stimulus going on there, but actually the readout from the Politburo meeting was pretty much saying no change, happy as we go, which was a bit disappointing for investors. It's interesting with China that the Hang Seng here in Hong Kong is up over 20% so far this year, 24% I think last time I had a look, whereas the CSI 300, which is onshore mainland China equity markets, is only up 4%. So you can see that big disparity between those offshore Hong Kong stocks and the onshore mainland China stocks.
Well, as you say, plenty as always going on in Asia. Turning now to equities. Last week was one to celebrate for Google owner Alphabet, Facebook owner Meta, and Office owner Microsoft, which I've read collectively added $350 billion to their valuations on the back of their very strong earning results last week. I remember last year there was a lot of talk about the absolutely amazing sums that all of those companies and other big US tech companies are spending, investing in the infrastructure that powers artificial intelligence, AI, and how long it might take them to see a return on those outlays. Do these strong results that we've seen from them now vindicate that money they've spent on their infrastructure?
Again, it's a bit of a yes or no answer, unfortunately. So if you just take earnings, it's been very, very impressive. So the S&P 500 so far this year, I think that as of Friday, the earnings growth compared to last year's Q2 is going to be up about 9%, maybe 10%. So pretty impressive, isn't it? That's great. But if you split it down, the Magnificent Seven, which is a lot of those stocks that you mentioned, plus a couple, including Nvidia, which is yet to announce their results. They do that late at the end of August. So we're trying to extrapolate that. Those Magnificent Seven stocks, the earnings are up about 25% over the year. So that's incredible. The S&P minus the Magnificent Seven. So I guess the S&P 493 is up only 4%. So that's nothing special, right? So the S&P 500 has really been driven by this Magnificent Seven. And look, there's a lot of positives around this. But I also hear the sort of the bearish argument, which is a lot of these companies are basically investing a lot, and they're investing a lot buying infrastructure off each other. So you sort of spend a load of money and that turns into earnings on day one. But then those assets have got to generate themselves earnings going forward. You only depreciate those assets over the long term. So we're hoping that the chips that they're all buying will turn into dollars and cents going forward. But at the minute, we're banking all those profits on day one because they're all buying all these things off each other. So it looks really impressive. It is impressive, but we still do need to see the output and the actual productivity gains or whatever it might be.
So no real vindication just yet. I saw a really interesting piece the other day on Microsoft, which made the point that normally you'd expect a company that's seen quarterly profits up about a quarter to be in hiring mode, going and picking up all the brightest people off universities and elsewhere. But in fact, it's been shedding jobs on the expectation that AI will increasingly do jobs that humans currently do or did in the past. What do you think about how AI might change the labour market in the longer term?
That's that word I mentioned earlier, the productivity word. It's a bit of a euphemism, isn't it, for basically people getting fired? So it can be, not necessarily, but the efficiency that AI can bring about. Yeah, that's the concern that some people have, that it's going to lead to people losing their job. A colleague of ours, James Carrick, did a great blog actually on this called Degrees of Doubt, looking at, I think there's been some headlines about new graduates finding it a bit more difficult to get a job. And is this about AI in terms of, the being replaced? And as with a lot of data and a lot of reports, there's a bit of spurious data analysis going on. The problem is that ChatGPT was launched 2022, basically the same time as the peak of the post-COVID labor market tightness, when everyone was, being hired, and it was people salaries were going up, particularly in the tech market. Everyone was going online, weren't they? So everyone wanted technology people. So to say that it's the job market has eased since then, is that because of ChatGPT, AI, or is that just because it was incredibly tight at that moment? He makes an interesting point, which I agree with, that it usually takes a recession in order to accelerate efficiency gains. And again, that's a sort of word for job cuts, isn't it? So right now, I think it's all still fine. I don't know the situation specifically in Microsoft, but I mean, the job market is still pretty strong. But when and if we do get a downturn, that may be when companies are particularly motivated to find cost cuts and implement all these efficiency savings.
Okay, well, it feels like we've covered absolutely loads of ground already, but as always, I'm sure there are lots of big stories that aren't on my radar that I've not touched today. With that in mind, what's your number of the week for us this week, Ben?
Yeah, I don't know if it's a big story, but I did write a LinkedIn post this week that I thought is maybe worth just highlighting here. Just thinking about some of the numbers that I mentioned earlier, actually. So my number is 5%, and that is the yield on the US dollar investment grade credit index. Why is that important? So that's the borrowing yield of the top companies in the US or globally in dollars, what they borrow at 5% on average. Now, US GDP has been running okay so far this year, but it's expected by the consensus to slow down to about 1% growth. That's a real number. So in terms of nominal, maybe it's up to sort of 4% growth. I also mentioned earlier that the S&P 493 earnings are up about 4%. But that's an issue, isn't it? If growth is at sort of nominal 4%, if earnings are at 4%, and yet they're being asked to pay 5% on debt, well, that's going to be squeezing at some point, isn't it? The equity returns. And that's probably one of the reasons why President Trump is asking for lower interest rates going forward, and maybe there will be lower interest rates going forward. But then if those long-term yields, if that curve shape remains pretty high, then even if you do cut interest rates, those long-term borrowing costs are not going to be coming down. So it's a bit of a tricky situation. Now, normally I wouldn't be too worried about this, but it is also happening at the same time as equity markets are pretty much at all-time highs. So there's a lot of confidence, a lot of bullishness, a lot of focus on those magnificent seven, but the underlying conditions aren't particularly rosy. I'd say there's a few hurdles that need to get over before we can validate these extraordinary valuations.
Perhaps a time when something's got to give, we shall see. Well, thanks so much for your time as always, Ben. We'll be taking our customary summer holiday here on L&G Talks Asset Management, but we will be back in September and I hope you can join us then. As a reminder, this podcast is intended for investment professionals only and shouldn't be shared with a non-professional audience. The views expressed in this podcast are those of L&G's Asset Management Division, as at the date of publication. This podcast is for informational purposes only, and we're not soliciting any action based on it. The information discusses general market, economic, or political issues, or industry or sector trends. It does not constitute research or investment, legal, or tax advice. It is not recommendation or advertisement to buy or sell securities or pursue a particular investment strategy. Assumptions, opinions, and estimates are provided for illustrative purposes only. There is no guarantee that any forecast made will come to pass. No party shall have any right of action against L&G in relation to the accuracy or completeness of the information contained in this podcast. Where this podcast contains third-party information, the accuracy or completeness of such information cannot be guaranteed, and we accept no responsibility or liability in respect of such information, not for distribution to any person in any jurisdiction where such distribution would be contrary to local law or regulations. Copyright 2025. Legal and General Investment Management Limited is authorised and regulated by the Financial Conduct Authority. Unless otherwise stated, references herein to L&G, we and us are meant to capture the global conglomerate that includes, in the European Economic Area, LGIM Managers Europe Limited, authorised and regulated by the Central Bank of Ireland as a UCITS management company pursuant to European Communities Undertaking for Collective Investment in Transferable Securities Regulations 2011 as amended, and as an alternative investment fund manager pursuant to the European Union Alternative Investment Fund Managers Regulations 2013 as amended. In the USA, Legal and General Investment Management America, Inc., a US SEC regulated investment advisor. In Japan, Legal and General Investment Management Japan KK, a Japan FSA registered investment management company. In Hong Kong, issued by Legal and General Investment Management Asia Limited, which is licensed by the Securities and Futures Commission. And in Singapore, issued by LGIM Singapore Pte Limited, company registration number 2022318766W, which is regulated by the Monetary Authority of Singapore. For full terms and conditions, please visit our website. To find more content, you can check us out on LinkedIn or on our website.